We're really pleased to host this event. One of the things that when the Hutchins Center was formed, it was a deliberate focus to look at both fiscal and monetary policy, and it's become clear since then, in the last 3 years, just how important the interaction of fiscal and monetary policy is, particularly in an era in which we have a low R star. And so we've been looking for ways to bring people together who think about both those things and to think about what it means to, how should we think about the federal debt in an era where we have very low interest rates and perhaps low growth? And how should we think about the relationship between fiscal and monetary policy if we have every reason to expect we will once again find ourselves at the effective lower bound? And so we thought we were really pleased that we have these two papers, people who are thinking about these things. I'm not going to introduce the papers. There's a copy outside, and I'm sure you can read them, and we'll hear about them soon. As you can see from the agenda, we're going to simply start with one paper and then go to the other and then have a discussion in which Ben will participate. This is a small group by design and all people who are familiar with the issues, so I haven't cleared this with any of the presenters, but I think if you have something you want to interject with, this is the kind of situation where we can allow that. Louise and I will manage the thing, the usual, put up your card if you have something to say. Anything to add?
No, should we go around the room?
Yeah, why don't we, that's a good idea. So.
Okay, I'm Louise Shaner from the Hutchins Center.
I'm Bill English from the board in Yale University.
Chris Ursig from the Federal Reserve Board.
David Lopez Salido from the board.
Where's Emmy?
Philip Barron.
Yeah, sure. But where do you get your haircut? Where do you get your haircut, Prel? Do you still go to Lenny at the Federal Reserve Board? Oh.
He is totally unaffiliated.
Norman Carlson, retired, worked at Treasury on debt management for lots of years.
Kevin Wysocki, Congressman Barr's office, Financial Services Committee.
Ted Gayer, Brookings.
Ralph Bryant, Brookings.
Also, that's from
All right, is this on? Yeah. Thanks very much for having me. This is, before I get started, I have to give you the standard disclaimer. These are my views and do not necessarily represent the views of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So I want to start with the premise that in a low growth, low real interest rate world, it's not obvious how to think about the sustainable level of public debt. Typically, we think about debt sustainability based on the cost of servicing the public debt. And the cost of servicing the public debt is the gap between the real interest rate and the growth rate of the economy. So we can look at historically what the cost of servicing the debt has been for the U.S. over a fairly long time horizon. So what I'm plotted here is the real interest rate on government debt. So I'm taking the nominal interest rate on 10 years minus a 3-year moving average of inflation minus the real GDP growth rate of the U.S. And so that's a measure of the cost of servicing the public debt. And if you smooth that out with the red line there as a 5-year moving average, what you see is that there are extended periods of time in which the cost of servicing the public debt is quite negative for the U.S. And so if you just look at the post-war period, there's actually, for much of the post-war period, the cost of servicing the public debt has been negative. And it's only sort of the 1980s to mid-1990s where the cost of servicing the debt turned positive. So even though on average the cost of servicing the debt is negative, there is some degree of volatility. There are these periods in which the cost turns positive. So what I'm thinking about in this paper is this basic trade-off between whether you want to try to take advantage of the fact that interest rates are low, and when interest rates are low, we live in a world where R is less than G plus N. That implies that increases in the debt to GDP ratio actually raise revenues for the government. And so you might want to take advantage of that, but there's a drawback to that to that kind of policy, because if you have a large stock of public debt, then if the interest rate reverses, if real interest rates rise quite quickly, that can impose that kind of reversal can impose a sizable fiscal cost. It can require a sizable fiscal contraction that's needed to bring the debt back to a sustainable level. So in this paper, I'm going to look at that trade-off. I'm going to empirically explore the evidence on the level and variability of debt servicing costs, and then I'm going to employ a quantitative model to study implications of, if we think about what are the drivers of low growth, what effect do they have on the real interest rate and the cost of servicing the debt. So just again to fix ideas, where does this R minus G thing come from? Well, if you just look at the first equation, that's just the government's flow budget constraint. Taxes in plus new debt issued has to be used to finance government expenditures, plus repaying old debt inclusive of interest. And in steady state, in trying to keep the debt to GDP ratio constant, it has to be the case that taxes cover government spending, plus that second term, which is the cost of servicing the debt. The cost of servicing the debt is going to depend on the relationship of real interest rates to the growth rate of the economy. And I've broken up the growth rate of the economy into GDP per capita growth, which is little g, and N, which is population growth rate. If R is greater than G plus N, then the cost of servicing the public debt is positive. Higher levels of the debt to GDP ratio means that you have to raise taxes in excess of government spending to cover the cost of servicing the debt, and the reverse holds when R is less than G plus N. So using a data set of 17 advanced economies, I can ask the question about, on average or at the median, what is the cost of servicing the public debt? And it turns out that that cost is quite low. So for all these countries from 1870 to 2013, the cost of servicing the public debt was just 8 basis points. For in the post-war period, that turns negative 38 basis points, and it's actually more negative for the U.S. For the U.S. in the post-war period, the cost of servicing the public debt is negative 1.35%. There's a substantial variability, though. So if you look at the interquartile range, that interquartile range is not small. There's a 5 percentage point interquartile range. It's a bit narrower for the U.S., but there's still substantial variability in the cost of servicing the debt. Nevertheless, countries will spend significant periods of time in a R less than G plus N world. So about 50% of the time, real interest rates are less than the growth rate of the economy, and some 20 to 30% of the time they're significantly negative. So from this perspective, it might seem like it would make sense to have high debt to GDP ratios in order to raise real revenues. So as I mentioned, we currently live in a world where R is less than G plus N, but we might want to think about what's the probability over the next 5 or 10 years that we revert to a world in which R turns greater than G plus N. And so the way I think about this is I run a Probit regression, and this Probit regression is trying to measure what's the likelihood in the next 5 or 10 years that the cost of servicing the debt turns positive. And I can base that on the current level of the cost of servicing the debt, the debt to GDP ratio, the population growth rate. I can use those as covariates to see what's the predicted likelihood over the next 5 or 10 years of reverting to a positive cost of servicing the debt. And those probabilities are given here. That first line says that there's about a 50% probability that over the next 5 or 10 years, given the current configuration of the cost of servicing the debt, et cetera, that we will revert to a state in which the cost of servicing the debt turns positive. Now, if we think that the underlying growth rate of real GDP per capita is somewhat higher than what it is today, those probabilities drop a little bit. If we are more pessimistic about real GDP growth, those probabilities rise a bit, but nevertheless, they're around 50%. Now, so what's the what's the cost of moving into a world where R is greater than G plus N? Well, if I just think about the median cost of servicing the debt when in a world where real interest rates exceed the economic growth rate, that median cost is about 1.7%. If I apply that to a debt to GDP ratio of 70%, that means that the cost of servicing the debt will go to 1.2% of GDP. So we currently have a negative fiscal cost of servicing the debt going to a positive fiscal cost. We're talking about a 2 percentage point of GDP swing. That's fairly large when we think about deficit reduction proposals. Deficit reduction is typically not, at least in the recent last 20, 30 years, that's at the upper end of deficit reduction. So far, I've just talked about this object, R minus G minus N, as sort of just this exogenous object in the data. But macro theory suggests that there are strong connections between whatever the underlying drivers are of growth and the real interest rate. So in the second part of the paper, I use a quantitative model to endogenize the behavior of the real interest rate, and I ask the question that if we think about what are the drivers of low growth in the U.S. economy, what impact does that have on the real interest rate and on the cost of servicing the debt? Now, to give you an example, in my model, it's going to be the case that, for example, lower population growth is going to reduce the real interest rate, but lower population growth has an ambiguous effect on the cost of servicing the debt. Why is that the case? Well, notice that lower population growth is going to directly affect economic growth. Lower population growth means lower economic growth rates, but it also lowers the real interest rate, and so its effect on this gap between R and G plus N is not obvious. So it may improve the cost of servicing the debt, it may worsen the cost of servicing the debt. For the same reason, too, it's not obvious that an increase in the public debt will always yield more revenues in a world where R is less than G plus N. It's possible that an increase in public debt, it has indirect effects on the real interest rate that may offset the direct effect of a higher stock of public debt. So to pursue this question, I'm going to use a quantitative 56-period life cycle model. Households are going to face a realistic life cycle profile of income. They're going to save for retirement. They face some mortality risk. And I'm going to use that model to explore the underlying drivers of low interest rates, low population growth, low productivity growth. And I'm also going to include this term omega, which is a stand-in for flight to safety or for a desire to hold government debt relative to other types of assets. I'm going to try to make this model as realistic as possible so it matches the U.S. labor share, it matches the investment to output ratio, matches a measure of the real interest rate, and a measure of the risk premium. So from my model, I can look at what's the effect of changes in population growth rates and changes in productivity growth rates on the real interest rate. So what I've plotted here is essentially the sensitivity of the real interest rate to changes in population growth, changes in productivity growth. The gray line here is just a 45-degree line that goes through the point at which I calibrate the model. And what you'll notice is that that line for population growth is flatter and it has a slope of less than 1. And the line for productivity growth is steeper and it has a slope greater than 1. Why is this important? Well, if you think about a slowdown in population growth, a slowdown in population growth is going to lower the real interest rate, but it lowers the real interest rate at less than 1 for 1. And so what that means is that if you go back to this equation up here, the direct effect of slower population growth dominates the indirect effect on the real interest rate. And so slower population growth worsens the cost of servicing the debt, makes it more expensive to service the debt. But the opposite holds for productivity growth. Slower productivity growth has a stronger effect on the real interest rate than it does on its direct effect on growth, and so it actually improves the fiscal situation, which is kind of counterintuitive. Now, all those conclusions are reversed when you go in the opposite direction. So the punchline here is that we can then think about different scenarios, like if productivity growth accelerated back to its sort of 1990s levels. We're not entirely sure why it slowed down. If it accelerated back to its 1990s levels, what would that imply for the fiscal cost of servicing the debt given a debt to GDP ratio of 70%? And what I find from the model is that would imply the implied change in the real interest rate would require a 0.5 to 0.8% fiscal consolidation, which is sizable but not extraordinarily large. By contrast, if population growth, which is currently 0.7%, a slight slowdown in population growth would imply a relatively small fiscal consolidation. So when we think about the risk perspectives, what really matters is whether we think that real GDP per capita growth or productivity growth is going to suddenly accelerate or further decelerate. A further slowdown in productivity growth is beneficial from a fiscal standpoint. A rise in population growth is also beneficial from a fiscal standpoint. This is, again, a very narrow way of looking at it, but that's what comes out of the model. And if you have a decline in risk premia, if risk premia revert to sort of the average that they had from 1980 to pre-Great Recession, that's going to tend to raise the real interest rate. That will also require a small fiscal consolidation. It's worth emphasizing here that the current sort of configuration of policy in terms of immigration policy, in terms of tax policy and so forth, is very much geared towards increasing G, if we take it at its stated aims, and decreasing N. And so that particular combination of policy from a fiscal perspective is one that's likely to move interest rates in a way that is not beneficial for debt sustainability. So lastly, as I mentioned, a change in the debt to GDP ratio will also will have two effects on the amount of revenue that the government raises from in a world where the real interest rate is less than the growth rate of the economy. So what the blue line shows you is that there is a level of debt that maximizes sort of the gains from that you can exploit from a low interest rate world. So that level of debt is actually lower than the current level of debt. The current level of debt, as I said, is 70% of GDP. The revenue maximizing level of debt, again from a very narrow perspective of just maximizing the amount of revenues that you get from issuing debt, is actually a little bit lower. And that might be counterintuitive from what I said earlier. The reason for that is that the direct effect of a decline in the debt to GDP ratio is dominated by the indirect effect on the real interest rate. Lower debt to GDP ratio will lower the real interest rate, and so it maximizes sort of the unit benefits per unit of debt. The other thing that's true in this model is there's still a crowding out effect of debt. So a lower debt to GDP ratio will tend to increase the investment to output ratio, and that's going to be beneficial in this world because there's no capital accumulation due to the presence of intermediation frictions and markups in my model. All right, so I'm going to leave you then with just these key takeaways. On average, the cost of servicing the debt is frequently negative across the U.S. and other advanced economies. The servicing cost, however, shows substantial variability and a moderate likelihood of reversion over the medium term. It's important here, my model suggests that population growth and productivity growth will carry opposite implications for the cost of servicing the debt. And even though we live in a world in which R is less than G plus N, the revenue maximizing level of debt in my model is actually lower. There's important limitations to this approach that I think we'll talk more about. There's no reason to think that this measure of cost of servicing the debt is a sufficient statistic for the optimal level of debt. And the optimal level of debt in the context of my model is going to depend on quite a few things that are worth thinking about.
Thank you for inviting me to discuss this paper. It was a pleasure to read it, and overall I thought it was a very interesting paper. For me, one of the most interesting results that I haven't fully absorbed is just an empirical fact, how often the net fiscal cost of servicing the debt is negative. And you see that it's true in the US over a very long horizon, it's true across countries also. So I thought that was just very interesting. I have some comments on some of the results in the paper, but that's not going to be the main focus of my discussion. So, for example, there's one surprising result that Neil talked about, which is that if you have an increase in productivity growth, okay, it's actually going to worsen the net fiscal cost. Or if you flip it around, if you have a decrease in productivity growth, that would be good for the cost of servicing the debt. And I think that's a result that relies on a pretty strong assumption, which is a very low, mechanically in the model, very low intertemporal elasticity of substitution. And I think that empirically, my understanding is that there's not a very strong documented empirical connection between growth and interest rates. And there's a very strong one in the model which is responsible for that result. So I would take that one with a grain of salt. But overall, I thought it was a very interesting analysis. I'm going to focus my discussion on some considerations that are missing and I think could be important and could be incorporated perhaps in the next version of the draft. I don't have a lot of time, so I'll go relatively quickly, but I want to talk about debt maturity, about inflation, about the fact that the exercise is carried in a closed economy, and I think there's a case to look at these things in the context of an open economy with a very open capital account like I think describes the US. I'll talk a bit about some other drivers of interest rates, like self-fulfilling crises and panics and things like that. And I'll wrap up, if I have time, by speculating on the special role of the dollar and the way to think about the consequences, perhaps, of these shifts in fiscal costs. So I want to start with a thought experiment that I'm going to take, I'm going to construct from the paper. So we're going to start with the current situation. So debt to GDP is about 70%. The interest rate that Neil uses is 0.5%, G is 0.7%, and N is 0.7%. So if you look at the current situation, the net fiscal cost is negative, minus 0.9%. And if you multiply that by debt to GDP, that gives you a net cost of servicing the debt of minus 0.6% of GDP. Okay, so you get net revenues in some sense from sustaining this level of debt. And I want to think about the sort of experiments that Neil has in mind, which is a deterioration in this net fiscal cost. So there's a risk that we might revert to a situation where the net fiscal cost is very different, it's very positive. Okay, and I'm going to take quite a big shock just for illustration. Okay, so it's a reversion to the 75th percentile of net fiscal cost. And so that would bring it up to 4.1%. So we go from minus 0.9 to 4.9. That's a 5% shift in the net fiscal cost. It's a big one, but one that's there in the data. It's not crazy. So that would increase the net cost of servicing the debt close to 3% of GDP. Okay, so that's pretty substantial. You would have to raise taxes by 3% of GDP. Now, let me think about debt maturity in this context. So in the model, there's not much talk about debt maturity. It's pretty much ignored. And if you look at, or another way to think about it is the paper operates as if debt was completely short-term. So there's no fiscal hedging through maturity. But if you have a long maturity, then when interest rate increase, say, and then the value of the debt is going to decrease, and that's going to provide some fiscal hedging. Okay, so your net fiscal cost increases, but the value of your debt decreases, and so that absorbs part of the shock. The question is how much is in there in the data, and what could we do about this? So suppose all the increase in the net fiscal cost is driven by an increase in interest rate. So interest rates increase by 500 basis points. So if you take into account the fact that the duration of U.S. debt is approximately 4 years, you find that the reduction in the value of debt from such a shift is about 20%. So it's very sizable. Okay, and just to loop it back to the sort of calculations that Neil is doing, that would reduce the cost of servicing the debt from 3% of GDP to something closer to 2.2% of GDP. So already if you take into account the maturity structure of government debt, there's quite a bit of fiscal hedging and something that will protect the U.S. against such adverse shifts. And I think that's something that could easily be taken into account in the paper. Of course, you could ask, if you go at it from this perspective, what should we do? Perhaps we could manage the maturity of the debt. So there are a lot of considerations that go into that, and I'm going to focus narrowly on the one at hand here. So suppose that you lengthen the maturity of government debt to have more fiscal hedging in response to these kind of shocks. So let's say we lengthen the duration from 4 years to 10 years. So it's a very substantial lengthening of the maturity. Then you see that the amount of fiscal hedging is much larger. Okay, so there's a very bad shift in net fiscal cost. You have to increase taxes by 3% of GDP, but if you have this shock absorber built in there, then you only need to increase taxes by 1.4% of GDP. Of course, maturity is going to work only for shocks to interest rates, not to other drivers of net fiscal costs. So you would have to use other things to get at that. Another thing you could look at is inflation as a shock absorber. So it doesn't have to all go through taxes. And obviously that's not the way we like to think that we conduct monetary policy. We usually have monetary dominance, but sometimes bad things happen and you can have shifts to fiscal dominance. So let's imagine that we have something like that, okay? And that allows some inflation to go through. And I'm going to consider a large increase in inflation, let's say 1%. Okay? So in response to this very bad fiscal shock, inflation increases by 1%. So it's a pretty bad scenario. What would be the reduction in the value of debt if you take into account the current maturity? It would be trivial, okay? Something like 4%. So if you want to get much more fiscal hedging through inflation, you would either need to drastically increase the maturity of the debt or to allow much more inflation, so a much worse thing. So another consideration that's not taken into account in the paper, and I think it could, is the fact that the U.S. really has an open capital account. Okay, and it's very misleading to look at the size of the current account or the size of the trade balance to assess how open the U.S. is. Okay, so let's assume a completely polar assumption to that Neil made, that the capital account is completely open. Okay, and you know there's good reasons to think that that's not a terrible approximation. If you just look at debt, 30% of the stock of U.S. debt is held abroad. Well, that changes completely the way you want to think about these shocks. Okay, so if you have domestic changes in B, in G, and in N, they're going to be reflected in capital flows and exchange rates, not so much in interest rates. Okay, so they wouldn't be necessarily the drivers of the increase or decreases in net fiscal costs. So it's going to shift your focus away from local domestic changes and towards global changes. And if you adopt that perspective, then you see that other sustainability questions are raised, like external sustainability, which can be analyzed with very much the same kind of math that Neil was organizing. Of course, there are a lot of differences because there's something on the asset side of the balance sheet of the U.S., but this is something that could be taken into account. And finally, I want to talk a bit about self-fulfilling crisis. So I think you probably all understand how this is possible. It's when investors start doubting that the government will behave, either by not defaulting or by not inflating away the debt or things like that. They start charging higher interest rates, and the very fact that they charge higher interest rates increases the net fiscal cost for the government and pushes the government to do exactly what the investors were worrying about. Okay, so that's how it works, and there are a lot of instances in history where we think these sorts of logic captures the mechanics of certain events that increase net fiscal cost. Well, that's going to reintroduce a link between domestic developments and net fiscal cost, because the risk of such a crisis is now going to depend on domestic issuance. Okay, so there's a new link between debt and interest rates, but it should be interest rates that incorporate whatever risk premia investor have in mind. So that's a link that would be there and a trade-off that could be explored even with an open capital account. And finally, you may just wrap up by perhaps thinking a bit more broadly about what could be the consequences of a bad fiscal event, a deterioration in the fiscal situation of the U.S. So the U.S., as you all know, has a very special role in the world and the international monetary system. 60% of world reserves are denominated in dollars. A large share of goods are denominated in dollars. And there are reasons to believe that the U.S. is reaping large benefits from this situation. And one question that's been posed in history and perhaps poses itself again is whether some of these benefits could be lost if there was a negative fiscal event of the sort that Neil considers. So back in the Bretton Woods days, there was a prominent economist, Robert Triffin, who speculated about these kind of possibilities and sort of foresaw the unraveling of Bretton Woods. And the question is whether we could have something that looks like a Triffin event in the future.
Thank you so very much. That was great. I had all these questions for him. You went through all of them. If people have questions, put their cards up, please, and we'll go around. I'll start. I'm going to, like I said, most of them were talked about, but I want to talk about them again. So one of the very strongly counterintuitive results you had was this relationship between growth and debt sustainability. So in the recent Trump budget, people are saying they double counted the effects of growth. I think you're saying they had the wrong sign, even on the effects of growth. And have you looked at two things? One, have you played with the model to change that elasticity of substitution and see kind of how sensitive it is? Because I assume it is quite sensitive. And also, what do you think the is there any empirical? Is it just all coming from this OLG model where we're just taking some parameter, or is there any empirical work that backs up what you're finding?
Okay, so yeah, I think that was I find that surprising too, but it is driven by, as Emmanuel said, the elasticity of intertemporal substitution. My understanding is, in just looking at the literature, that elasticity of substitution is typically thought of as less than 1. And if it's less than 1, then approximately it's going to be, the closer it is to 1, the closer the movement is 1 to 1. And there's no real benefit or cost either way. The farther it is from the more that it's less than 1, then you get this effect of productivity growth moving the interest rate more than its direct effect on growth. So on something like the Trump budget or how we should think about productivity enhancing policies, I think that it's important to realize that I was just looking at steady states, right? And so it could be the case that you have a policy that has a level effect on productivity. There's an important transition there, and that once you take into account that transition, that this sort of minor change in fiscal cost in the long run is there would be no change in fiscal cost in the long run because there's no long-run effect on the growth rate of productivity. But there's this level effect on productivity that's beneficial. And I think most of the policies that we have in mind are more of this sort of level shift than actually changing the underlying growth rate of productivity. I'm not aware of much in the way that fiscal policy can do about the long-term growth rate of productivity. And so my experiment there is much more, we don't quite know why productivity accelerated in the 1990s, has slowed down so much today. So if I was to think about sort of the balance of risks, my guess would be it seems feasible that productivity growth could accelerate back to 1990s levels. Through the lens of my model, that suggests that the interest rate effect would be quite sizable. So that's sort of how I think about those.
So two questions, actually. If anybody have, yeah, good, okay, Bill. I'm going to follow up on that, and then I'll pass it to Bill. So you're thinking about, there's two issues. One is you're thinking about it very much from the perspective of the federal government kind of as a private borrower, right? Like they're not thinking about the social welfare. They're not thinking about, so from that perspective, I think you should think a little bit possibly more carefully about the effects of productivity growth on the federal budget, because I think you probably have a linear, we have a tax rate, but to the extent that poverty goes down and this, means tested programs go down, or we have progressive tax rate, and so productivity growth actually boosts revenue more than 1-for-1, that could offset it, right? So when you're thinking about really let's model the fiscal situation, then I think being a little more careful what we think of that, relationship between productivity and revenues and spending is worthwhile. And then again, thinking about, obviously productivity growth is good, right? I mean, so, and what is the taxing capacity? Like, so with current tax rates, maybe, we're in a bad situation, but it's also a lot easier to raise taxes when people are richer, right? And so both of those things kind of, I think.
So just I think my prior is that while the view in Washington is that there's a whole set of policies that would enhance productivity and productivity growth, I don't know that that's. I think that's possibly true. It's not clear that the set of policies that are being considered will do that, and it's not clear that the delta is all that strong, that you can really move productivity all that much. So the way I treated it in the model is that it's moving around for reasons that are exogenous to policy, and to a first approximation, I think of that as the most defensible way to think about it, but I think that it's certainly possible to think about a lot of these channels, public investment channels, effects on human capital, and so forth, that would clearly be beneficial.
Yeah, I wasn't even talking about just saying that, like, if people are richer, then you can change taxes and make this debt sustainable, not because you're not even causal, but Bill.
Sorry, I'm going to go in a different direction. I thought the initial empirical results were incredibly interesting. I wouldn't have guessed we had such long periods of negative fiscal costs. But looking at the U.S. graph, it struck me it would be really interesting to know more about what seems to trigger these transitions from negative to positive, or from positive back to negative for that matter, but trying to understand better what's driving those changes. So looking at the U.S. Graph that you have, figure 1 in the paper, the striking thing is in the post-war period there's like one event, and it's the Volcker disinflation, it looks like to me, right? So you have this long period from before World War II through to about 1980 with negative fiscal costs, and then an abrupt rise, which I assume reflects higher real interest rates mostly, and then that kind of slowly tapers off. And so it looks like, one story would be inflation expectations are really sluggish, and that's really important somehow to this story. But anyway, I guess I would be really interested to learn more about, in other countries, what do these transitions look like, and is there a story we can tell about those transitions?
Yeah, I definitely think it would be. I didn't try to make us an effort to explain the transitions or explain in some deeper way what we see in the U.S. case. It is worth noting that across countries there is a strong common component in the behavior of sort of net fiscal costs, which I guess gets to some of what Emmanuel is saying about thinking about the open economy dimensions. So, but I agree that it would be quite interesting to think what are the drivers. But just on average, it just seems like the cost of servicing the debt is typically quite low or negative.
So I just had a couple of thoughts. One is that on the issue of the intertemporal elasticity being very low, it would be interesting to simply run your model through the period of the productivity acceleration of the late 90s and early 2000s, and to see what it implies for the real interest rate. Does the real interest rate go to say 10% in your model, rather than the data being in the 3.5% range? And the second is just to build on Bill's observation. It would be interesting to strip out the periods following World War I and World War II, because those are periods where ex-post real interest rates were extremely low. So in the late 40s and early 50s, we allowed the price level to increase pretty dramatically. It's interesting that investors seem to regard that as a one-time event in the aftermath of war. But it had an enormous role in bringing down the stock of debt. And so if you strip out those two periods, just be interesting to see how that shifts your results. I presume those are fairly substantial effects.
Yeah, so,
Why don't we just let people go
Go
around?
oh, sure, okay.
Jimmy?
So my comment is very closely related to Chris's. I would say there's a huge debate on the value of the intertemporal elasticity of substitution in asset pricing, and in particular the experiment he's describing of looking at how interest rates respond to changes in expected growth rate is essentially the experiment that people do in this literature that goes by the name of the long-run risks literature. And in that literature, as well as the disasters literature, the view is that if you have intertemporal elasticity of substitution less than 1, then you get strange predictions. Like, for example, there's a disaster and people go into a disaster, you expect growth to fall, and the incentive to save, to smooth consumption is so great that you get a stock market boom. So you go into a disaster, you get a stock market boom. Or, you expect high future growth, and, the stock market crashes. Or there's an uncertainty shock, and the stock market booms. Because there's kind of an intuitive sense that uncertainty is bad for the stock market, but in these models, although maybe recent events don't bear that out, but theoretically, the value of the intertemporal elasticity of substitution matters a lot for that. Now, that is not to say that that you're not right, that there's other evidence, in particular Hall's classic paper where he just does a scatter plot of risk-free interest rates versus consumption growth, and there's just not much there. So I think there really is some question as to what the debate, what the value of this is, but there are major issues with the standard model with the intertemporal elasticity of substitution less than 1, including, that are very closely related to what you're looking at, including, for example, very related to what Chris was describing, the puzzle of how you get, with a very low intertemporal elasticity of substitution, simultaneously expected growth, and a very low risk-free interest rate. So anyway, I think those issues might be interesting to think about more.
Bill?
So I had a brief comment and then a question I'd like to ask Neil. The comment I'd like to make is that it's sort of somewhat in defense of the argument that Neil's making. This slightly surprising result we see with growth is only about per capita growth. I'd like to emphasize that. And if you think about growth of the entire economy, including population growth, then you take the average of those slopes of those two lines. If you think growth is roughly, say, half per capita and half population, then the average of those two lines, the slope is 1. So if you're thinking about growth in a more general sense, then the slightly surprising result does go away. And I think the more general point that we can take from Neil's paper, and something that I think is very useful for policymakers, is the point that R and G are correlated. That you often hear policy debates about interest rates being low or growth being low, and people not realizing the two are connected and they move in correlated ways. So that I think is really important. The question I'd like to ask Neil is if you could say a little more about how that key diagram you have that really explains the model with those two lines with slightly different slopes, how those two lines move in response to changes in the total debt stock. Because that's going to determine how the fiscal costs move around as the total amount of debt moves. And that's the key mechanism, I think, in your model. I'd just like to understand that a little more.
All right, any more questions before we turn it back to Neil? Neil, a couple minutes.
So on the question about the late 1990s productivity acceleration, so in my paper with Gowdy Egertson, we do an experiment like that where we think about the we're trying to assess the contribution of slow productivity growth to the decline in the real interest rate. And it is true that now, I mean, there's drawbacks to this analysis in that it's perfect foresight. So people anticipate that there's going to be a productivity boom in the late 1990s, and then it's going to fall off in the mid 2000s. So that tends to temper the effect. But you do get some rise in real interest rates from higher productivity growth. But it's not anything like it goes up to 10 percentage points or something like that. So it's not a massive swing. You just get a small sort of hump shape, maybe half a percentage point or something like that. Now, whether that's being driven by, and in that paper we have a similar low elasticity of intertemporal substitution. In whether that's driven by by these perfect foresight effects, or whether it's driven or whether it's consistent if you expected that to be permanent, I think is an interesting question to investigate. And I completely agree with Emmy's point about trying to think more about alternative evidence on the intertemporal elasticity of substitution and how that affects my conclusions. On your question about how total debt moves around the elasticity of the interest rate to population growth and to productivity growth, I think it's just a level thing. So an increase in public debt is going to increase the real interest rate, but it doesn't change that slope very much in those graphs. Because, I mean, what's the experiment in those graphs? The experiment in those graphs is just changing population growth, holding the debt to GDP ratio constant. So if you simultaneously, if you increase the debt to GDP ratio and then vary the population growth rate, you just get this sort of, it doesn't change the elasticity all that much. There are some interaction effects, but it's not all that strong.
Awesome, thank you so very much. We'll have more time to talk about both papers together at the end. Let's move on to, are you presenting, Bill?
Yep.
Bill.
Okay, thanks very much for inviting us to the Hutchins Center today. This is joint work with my colleagues Chris Ursig and David Lopez-Lito at the board, and we too have a disclaimer that says these are our views and not those of anybody of actual importance at the Federal Reserve. So our topic today is money finance fiscal programs, or colloquially helicopter money. There's been lots of recent discussion about the topic, and that interest reflects concerns about the ability of monetary policy to address persistent economic weakness, given the effective lower bound, as demonstrated by the Japanese experience over the last couple of decades, and experience in other advanced economies post-crisis, as well as concerns about a very low neutral real interest rate going forward if secular stagnation concerns pan out. So in particular, money-financed fiscal policy might offer a useful tool to provide additional stimulus if you're in a situation with a persistently weak economy, very low inflation or deflation, and monetary policy constrained by the effective lower bound and fiscal policy constrained by high debt levels. Just to preview our results, we find that money-financed fiscal programs can be a very powerful tool, at least in theory, boosting output and inflation substantially. However, such programs require a radical change in the monetary policy reaction function, and we're skeptical that such a change can be communicated clearly and credibly in many circumstances. But if the policy isn't well understood by the public and believed, then the effects on output and inflation will be smaller, or at least delayed, and that makes it a much less attractive tool for countercyclical policy. As a consequence, we'll argue that monetary fiscal cooperation involving more limited changes in monetary policy may be easier to communicate and more credible, and so might be more effective in addressing difficult policy situations. Before I turn to our model, I want to address a preliminary complication, which is the payment of interest on reserves. In the kind of standard textbook helicopter drop story, which I think drives everyone's intuition, the central bank pays for a fiscal expansion either with currency or with non-interest-bearing reserves, but with non-interest-bearing central bank liabilities. And then so long as the central bank doesn't reverse that increase later on, or doesn't begin to pay interest on reserves later on, in some sense you automatically get seniorage to pay for the fiscal expansion. But with interest on reserves, things aren't so simple. The central bank can pay for a fiscal expansion with a permanent increase in reserves, but then it can use interest on reserves or other tools to implement an unchanged monetary policy rule, and if it does so, then you don't get the seniorage revenue to pay for the fiscal expansion. So with interest on reserves, basically we see a money-financed fiscal program as consisting of three pieces. There's the fiscal action. There's an asset purchased by the central bank to provide finance for the fiscal action. And then there's a commitment by the central bank to a much more accommodative monetary policy. That's necessary to generate the increase in the price level that boosts nominal currency demand, that provides the seigniorage that then pays for the fiscal expansion. So turning to our benchmark model, we construct a fairly standard New Keynesian model. Households choose consumption, they choose hours worked, they choose money balances. Money's just currency in our model. And the way we set things up, nominal currency demand looks pretty standard. It just depends on the short-term nominal interest rate and the level of nominal income. Firms choose the level of output and employment. They set prices following this standard Calvo pricing setup. And the government chooses spending and taxation. The non-standard part of the model is monetary policy, where rather than a typical Taylor rule or something like that, we assume that monetary policy is chosen so that the government spending shock, GT here, is paid for at least partially with seigniorage, ST. And that coefficient phi tells you what fraction of the government spending shock is paid for with seigniorage. If phi is 1, for example, then there's full monetary financing, and we spend most of our time talking about that. Then using the household money demand function, we can rewrite the monetary policy rule, as we have in the middle here, as a rule where the central bank is setting the nominal interest rate based on a price level deviation from a price level target, P star tilde, and consumption's deviation from its steady state value. So you basically get a monetary policy rule that's a price level targeting rule. But importantly, that price level target moves, and it moves, if phi is 1, it moves up fully to reflect the increase in government spending. Okay, so in terms of the model's expectations, for now I'll assume rational expectations and that changes in policy are fully understood by the public and are seen as completely credible. Those are important assumptions, and I'll come back to those later. So we use the model to simulate the effects of a money finance fiscal program. In the simulation, we assume government spending rises by a total of 1% of GDP over several quarters. And the central bank pays for the spending with seigniorage using the policy rule I just described. And given our calibration, seigniorage is roughly 10% of outstanding currency. So ultimately, the price level is going to rise by 10%, which is a fair amount given the fairly small fiscal action. The results are shown in Figure 1 in the paper, and basically this policy is very effective in the model. Output rises about 1.5% relative to baseline. That's the top left panel. Inflation rises nearly 2.5 percentage points, shown by the blue lines. The blue lines are the monetary financed fiscal program. Most of these effects reflect the change in the monetary policy reaction function. If monetary policy follows the Taylor rule, that's the dashed red lines here, you get much smaller effects on output, much smaller effects on inflation. And the reason for the big difference is that with the money financed fiscal program, the central bank has to move the price level up to the desired level. And to do that, it lowers the real interest rate by about 3/4 of a percentage point. And it keeps that real interest rate low for a long time, for several years. And the low real interest rate boosts aggregate demand and gives you the big effects on output. In terms of seigniorage, you can see in the left-hand panel here that seigniorage rises sharply with the introduction of the program. Basically, that seigniorage line exactly matches the government spending line in the previous panel, as it should by design. That's the idea. You're paying for the fiscal action with seigniorage, and the result for government debt is a sharp reduction in the debt to GDP ratio. That's because the seniorage pays for the fiscal expansion, but then you have very low real interest rates for a time, and that results in a reduction in the debt burden. And the stronger economy that results from the policy boosts tax income for the government, and that also reduces the debt-to-income ratio. So in figure 3 in the paper, we show what happens if you change to price level targeting, but you don't move to the higher price level target. That's the green dashed lines in this chart. So as you can see in the top right, the price level stays basically flat with the green dashed lines. You've adopted price level targeting, but with no change in the desired price level. And the effects of that are basically the same as the Taylor rule. You get very small differences in the effects on output, for example, as shown in the top left. So the big factor, the big difference in the money-financed fiscal program effects is that you have this higher price level target, as shown in the top right, the dashed black line, and the actual price level because of the accommodative monetary policy moving up to that price level target over time. In the paper, we examined 2 factors that influence our model results. I'll just touch on them briefly. First, currency demand could prove higher or lower than expected. If money demand is significantly lower than expected, for example, then inflation has to be higher to generate the seniorage to pay for the fiscal expansion. And second, the mix of the effects of the policy on output and inflation will depend on the slope of the Phillips curve. We assumed a relatively flat Phillips curve consistent with recent U.S. experience. But if the Phillips curve was steeper, then the boost to output would be smaller and the rise in inflation would be even larger, as we show in the paper. Now, an obvious question is what would happen if the money finance fiscal program either wasn't understood or it wasn't seen as fully credible. To explore this, we consider a version of our model with learning. So instead of full information and full credibility, we assume the public initially believes the central bank is unlikely to actually change its monetary policy rule, presumably because the central bank has a reputation for desiring low and stable inflation. But over time, the public will see the central bank's actions and can update its view of the central bank's intentions. So if the central bank sticks to the new policy for a while, then the public will gradually come to believe that the monetary policy rule has changed and take that into account in forming expectations. So to implement this approach, we assume the public can only see the stock of money, which is subject to random noise. So the public can't be sure just by looking at the money supply at a point in time whether the central bank has changed its policy rule or not. Instead, it's going to update its beliefs over time, and formally we model that using a Kalman filter. So here are the results with learning, and they're not surprising. Given that learning takes place over time, the effects of the policy on output and inflation just are pushed back in time. As the learning takes place, you get bigger effects. So as you can see by comparing the red dashed lines, which are the simulations with the model with learning, to the blue lines that are the earlier version of the model with complete credibility, basically the peak effects of the policy are pushed back several years under our calibration. And these long lags mean that the policy is less attractive as a countercyclical tool, since the largest effects are likely to come after the economy is already recovered. And the latent protracted effects of the policy may also make it more time inconsistent and so undermine its credibility further. So given the communications difficulties as well as the large inflationary effects that we find for even a relatively small money finance fiscal program, we thought it would be useful to consider a more modest form of cooperation between monetary and fiscal policy. So we consider 2 possibilities in the paper. On the one hand, a temporary shift to a more aggressive Taylor rule, and on the other, as I'll show in a moment, a shift to price level targeting, but with a smaller hike in the price level target than in the case of kind of the full Monty of monetization. So in this case, we're showing the effects of the monetary fiscal cooperation starting from a situation where there's a large aggregate demand shock, And that's left monetary policy constrained at the zero bound. Since there's going to be less monetary accommodation, not full monetization, we assume a larger fiscal expansion. So we're going to increase government spending by a total of 2.5% over time. And we show three possible monetary policy rules. So the black lines show the standard Taylor rule. The red dashed lines, flexible price level targeting, but with no change in the price level. And the blue dashed lines, flexible price level targeting with a target price level that's 5% higher as a result of the fiscal monetary cooperation. Now, with full monetization, you'd get an increase in the price level of 25%. So this is a much smaller increase than that. We think it would be easier to communicate and make it credible to the public as a result. As shown in the charts, a move to price level targeting alone does help to support the recovery, as others have discussed. But the effects with the higher price level target are considerably larger, as you can see from the difference between the red dashed line and the blue dashed line. In addition, as you can see at the bottom right, the higher price level target generates a decline in the debt to GDP ratio rather than the rise you'd get with the other policy rules. And that may be important if the initial debt to GDP ratio is very high. So let me end with just a few practical issues. First, you might wonder, given that most of the muscle from these monetary fiscal policies is coming from the monetary side, why do you have to use the fiscal policy at all? We think there are three reasons why the combination policy may be effective. First, it may help to make the change in monetary policy more credible sooner. If monetary policy is constrained by the zero bound, for example, then the public may not see that the policy rule has changed until the economy gets to a point where with the old policy rule you'd be lifting off, and you're not lifting off because of the new policy rule. So that would make it more obvious that there's been a change. Second, the fiscal strains and the possibility of default and associated costs may make the policy rule more credible. That is, it may help the central bank to commit to being irresponsible, which is useful at the zero bound. And finally, a joint program may improve the clarity of communications. If you have all of the policymakers, fiscal and monetary policymakers, announcing a program together, that suggests policymakers are united and committed to doing whatever it takes, and that may be helpful in making the communication clear and also making it credible. I'm out of time, so I'll just touch briefly on. We talk about some history in the paper. I think the lesson there is sometimes these sorts of policies seems to have big effects. Sometimes they don't, and there are a number of complications. But I think the history overall is consistent with our thought that communication and credibility really are problems with these sorts of policies. And finally, monetary fiscal cooperation naturally raises issues about central bank independence. And I think that gets you into kind of designing structures for how to implement these sorts of policies if you're thinking of implementing them. That's beyond the scope of our paper, but we point to a kind of dual key approach that Ben Bernanke pointed to in a blog post as one possibility. Thanks very much. I'll stop there.
Thanks so much. Emi Nakamura from Columbia.
Thank you. Thank you to the organizers for inviting me to discuss this interesting paper. Yeah. Oh, okay. That's great. Thank you. I want to start by talking about what helicopter money actually is. And as I was sitting here, I was thinking to myself, how is it possible that neither I nor Bill thought to show the picture of Ben Bernanke in a helicopter dropping money on the world that I always show when I talk about quantitative easing and unconventional monetary policy in the context of teaching? So that was definitely an omission, because that would have answered the question, of course. But
it is one that is much appreciated.
But since I don't have that, let me try to make some alternative commentary on this. This paper gives us one precise definition. I'm not sure it is the only definition, but it is one precise definition, which is they're going to think about a situation where there's some government spending, so that's the fiscal policy part, and it is entirely financed by seigniorage. In the narrow sense of the word seigniorage that we teach to undergraduates. Like, you print the money, and it's the amount of that in terms of real money balances, and you use that to pay for the government spending. So one of the implications of this definition is that because, there literally is just not that much money around, it actually does imply a pretty big change in monetary policy. Because if you're going to pay for this whole fiscal expansion using seigniorage, you need to print a lot of money. So that's just one, that's one comment. I'll come back to that. But one implication of that is that in the context of this model, where monetary policy does have effects, there's quite a large stimulus to output, and debt to GDP can actually go down. Because there's so much stimulus that, there's a sense in which it sort of pays for itself in some sense. So why is it a cautionary tale? That's the title of the paper. Well, one thing I thought was super interesting in this paper was this discussion of credibility. So this is a figure that Bill showed, which is illustrating the output boom under two scenarios. The blue line is the case of perfect credibility. The dashed red line is the case where people are learning about the policy in real time. And of course, what's so problematic from the perspective of the Fed about the dashed red line is that if they were trying to engineer a boom as a matter of some kind of stabilization policy, it would sort of be a problem if the boom doesn't show up until 5 years after they plan on doing it. So that I thought was a very interesting point about, as a cautionary tale, that maybe it's hard to figure these things out, and that this imperfect credibility would really cause a problem in terms of the implementation of this policy. And I think that this idea of credibility and communication is sort of a running theme behind the way the authors are thinking about these issues. So now let me come to how the authors frame the pros and cons of helicopter money in the context of this particular definition of what helicopter money is. So the authors and I had some back and forth on this, and so I'll overlap a little bit with what Bill said about this. But there's an interesting question of why these two policies, the fiscal part and the monetary part, would necessarily be combined in the same policy, that is the helicopter money policy. Because in principle, in their paper, one of the things they show is that it's really the monetary part that's kind of doing all the work. They have this huge monetary stimulus that's leading to like a 10% increase in the price level, something like that. And as a consequence, there's a huge stimulus to the economy. But of course, in principle, you could just think about doing that and not even combining it with the fiscal part. So one question is whether these two things, the monetary and fiscal parts, are bedfellows by chance. Are we putting them together just like a sandwich and they're the sum of their parts, or is there some sense in which they interact with each other? I guess a sandwich, it does interact with the different parts. So that's an interesting question. One response to that, a very interesting response to that, is Goethe Egerton's paper from 2006 called Committing to be Irresponsible that Bill talked about. The basic idea of that paper is that if you have a central bank that is not so credible, then it might need some way of really committing to create inflation. And so, of course, the Bank of Japan at the time comes to mind as maybe a case in point. And I think in Goethe's paper, he may have actually talked about the case of Japan. So the idea is that if you spend a lot of money and increase your debt, you make it really painful for the government, and therefore you give them an extra incentive to inflate, and that serves as a commitment mechanism to really make the inflation happen, even when ex post you might not have such an incentive to do it. So, most of you are probably economists in the room, you're familiar with this notion of commitment, but, if you're not, the analogy to everyday life is something like, the situation of, if you're thinking about trying to get your kids not to eat cookies from the cookie jar, ex post, after they've eaten a cookie, it may be very painful for you to lock them in their room for an hour. because they're screaming and they feel really bad for them. So so what you might need to do is if you had some kind of time lock where you could really commit in advance, yes, you'll have to be in your room for an hour, then the idea would be that in that case, the kids would know that that was going to happen after they steal the cookies from the cookie jar and they wouldn't steal them in the first place. So it's that kind of an idea here, that in principle, this government spending, the fiscal part of the policy, could help the Fed actually commit to this monetary stimulus. But in this context, one question that I have is the extent to which the Fed really needs a commitment mechanism. So different central banks probably differ in this regard, and just as maybe a statement of confidence about the Fed, about which some of the people in this room probably know much more, but there is evidence that the public does believe what the Fed says it's going to do, at least to some extent. So if we look at cases of forward guidance, there's certainly evidence that when the Fed says stuff about what it's going to do in the future, that it's going to keep interest rates low, things like that, bond markets move. So, there's some question as to how important this is, and I saw that in Bill's presentation, he was kind of putting this second on his list of what might be important. So just as an example, as I said, of where we see that the Fed does have some power of commitment, you can look at cases of forward guidance. Like in September 2012, the Fed said monetary policy would need to remain highly accommodative for considerable time after the economy strengthened. And this has been interpreted. There's evidence for the view that you can view this as a form of what has been now referred to in the literature as Odyssean forward guidance, in the sense that it's being interpreted by the markets as saying that the Fed is going to keep interest rates low, even when it might be in its interest, purely from a static perspective, to raise them. And it looks like there's some evidence that the bond market really believed that the Fed was going to keep its word. So maybe this commitment view is not so important for the Fed, but I think that's an interesting question to debate. So why else might these things be combined in the same policy, the monetary part and the fiscal part? Well, I thought the author's perspective on this was very interesting. They talked a lot about communication. So this was kind of an argument that I hadn't heard so much of before, but the basic idea was that if you just do a monetary policy, particularly at the zero lower bound, maybe the people in the economy, they just sort of don't notice. It takes a long time for monetary policy to have an effect. Interest rates in terms of the headline, interest rate, maybe you're already zero, people just don't notice. So I think one of the ideas they have is that possibly by combining it with a fiscal part, you just create a bigger bang. It amps up whatever stimulative effects there are, and potentially this leads people to notice the policy and leads people to respond more. So I thought that was an interesting argument that I hadn't seen before. So let me talk about one last thing, which is about some additional fiscal benefits and costs of helicopter money that are not part of the author's definition and that might be interesting to consider. So one is that, as I said at the beginning, they do have this sort of narrow definition of how they think about the fiscal benefits of this helicopter money, because they're really thinking about seniorage narrowly defined. You print money, and then what are the real money balances you get from that? But there are other fiscal consequences, particularly in a world of long-term debt. So in a world of long-term debt, you have changes in expected inflation, potentially, at least from this kind of a policy that massively increases the price level, that would affect the valuation of long-term bonds. And particularly in a world where many of the US's long-term bonds are held by foreigners, that might be a fiscal consequence that is important to consider. And another thing that isn't part of the author's framework is distortionary taxation. And in the context of distortionary taxation, it might be a benefit of this kind of a fiscal policy, potentially through the valuation of long-term bonds, that you would be able to have a reduction in distortionary taxation. So that's possibly a benefit that isn't there if we only think about the fiscal consequences from the perspective of seniorage. On the other hand, you could worry about debt, and I think this comes back to some of the conversation about the previous paper. Our models aren't perfect. There's been a lot of debate, for example, about the effects of forward guidance on current output, whether our models imply that the effects are too strong, things like that. And if the model is imperfect, then you might worry that a big run-up in debt, either for the purpose of stimulus or for the purpose of, or big increase in spending, either for the purposes of stimulus or commitment or communication or whatever, could actually lead to an increase in debt as opposed to a decrease in debt, as in the author simulation. Because you remember, in the author simulation, There's so much stimulus coming from the policy that debt to GDP actually falls. But if you get that wrong and debt to GDP actually goes up, then you might worry that there are costs potentially associated with concerns that that the debt level isn't sustainable and potential effects on borrowing costs. Thank you.
Okay, again, we're gonna put up cards and go around the room. Why don't we start with you and I'll.
Okay, thanks. So I think Ruth Judson and Dick Porter have estimates about 2/3 of U.S. currency is held abroad or more. If the helicopter drop is in fact currency that you're thinking about, I was wondering how that impacted what you do. And I think what matters may be what pins down the U.S. price level. If it's the total stock of currency, then I think maybe you're fine. If it's just the domestically held stock of currency, then the increase you're thinking about, 10%, is going to be much bigger relative to the domestically held stock, assuming that's all distributed domestically. So it might mean you can get away with having a smaller increase and having the same kind of bang for the buck. But I'm not sure, but it seems like something worth thinking about.
Well, I'll ask a question. And then I'll let you respond to Emmy and to that question. Okay. So I have two questions, and maybe they're dumb questions because I don't know this stuff very well. So one question I had is this idea of why you need the fiscal and monetary together. And you talked about this commitment device, like if you spend money and you build up the debt, then you need to inflate away. But combining it with Neil's paper, and also what we've seen, in a time when you're at the zero lower bound and interest rates are really low, actually a higher debt was actually making money for the federal government. Right? The fiscal costs were negative. So does that work? And building onto that, when we saw the huge rise in debt to GDP ratio, did we see a big increase in inflation expectations? That we saw it going from 40 to 70 in just a few years. So that's an experiment where we did this. And how did inflation expectations change? I'll start with that.
I'd just like to follow a little on what Emmy said. I'm having a hard time understanding how we can plausibly think about helicopter money if it relies on a whole lot of people putting $50 bills under their bed. And it somehow seems at odds with the way people actually behave. So even in this thought experiment, how is it you're going to get people to hold all this currency? I mean, I just have a hard time understanding in a kind of tell me a story how this is going to possibly work.
Yeah, so this is important, and let's talk about it, because what we're trying to do is come up with a kind of if you like, a real world counterpart to the kind of model experiment of dropping currency on a population where that's the only money supply or something, and then they go out and they spend it, and that pushes up prices and so on. So the question is, what is the real world counterpart to that? And our counterpart is that the fiscal authorities do some spending. They pay for that in the first instance by selling some bonds to the central bank, and the central bank provides a commitment to easier monetary policy that's going to boost the price level over time. That higher price level, as the price level goes up, whittles away the real value of the currency stock. People like to have some amount of currency relative to their real spending, and so they're going to replenish their currency stock over time, and they replenish it by taking more nominal currency from the central bank. So it's in some sense reversing the ordering that you have in your head, I think, which is, the central government injects a whole bunch of currency and that pushes prices up. In this case, what's happening is the easier monetary policy is raising the price level, and that's leading to people demanding more currency. But nonetheless, in the end, the public is holding more non-interest-bearing liabilities of the central bank, and that's providing the seigniorage revenue, which is, by the way we set up the problem, equal to the fiscal spending that happened. And so I think it's important that you see it kind of the right way around. It's a commitment to an easier monetary policy to push price levels higher, and that's what generates the higher currency.
I mean, one addendum is just that the fact that there isn't that much cash, which might be partly what you're talking about, is scaling the magnitude of the monetary experiment, because
Yes.
the less cash you have, and as it approximates zero, then the magnitude of the monetary experiment goes to infinity.
Absolutely, and so in our calibration, currency is about 10% of consumption, and so if you have a fiscal expansion of 1%, you've got to increase currency by about 10%, and that was what drove the 10% increase in the price level in our exercise. But if because of the rise of alternative transactions technologies, currency falls to 1%, then gee, you need a hell of a lot of inflation, much more. And to come to your question, John, I think the key question is how do the foreign holders of U.S. currency behave? If they too, as the price level in the U.S. goes up, need to replenish their holdings of currency, then that's fine, and everything kind of plays out as in our model results. If this maybe comes back to one of the things Emmanuel was saying earlier, if the foreigners say, gee, the U.S. just raised its price level a whole lot, might do that again, maybe I want to hold euros or something else, you could get a shift out of dollars in use around the world and into other currencies, and then you'd have a smaller stock of currency, and that would mean you'd have to have more inflation to get the seniorage that you want.
Mayo?
Quick question following up on the previous question. I was wondering if the program you had in mind is, if we try to compare it to monetary financing that's happened in history. My understanding is that in a lot of cases, when you manage to ramp up a lot of seniorage revenues, it comes with some form of financial repression and things like that. And so part of the seniorage is coming from some forms of money that's not directly currency. And that's held by financial institutions.
Yeah.
And that's not what you're thinking about.
That's right, it's not.
And
but
so you're going to get a much bigger increase in...
Yeah. So absolutely. So for example, you could imagine the central bank imposes higher reserve requirements and makes institutions hold a lot of non-interest-bearing reserves. That would be another way to generate seniorage that would not necessarily generate a lot of inflation. Instead, it would in effect be a tax on banks, right, over time.
Can I ask one question, then we'll...
And just to
go
follow
ahead.
up on that, so historically, my understanding is that after World War I, or during and after World War I, we issued bonds and appealed to patriotic motives to purchase these bonds. And the interest rates might have been a little below market even at the time, but then we had a big run-up in the price level, and had we allowed that to persist, and say had we devalued versus you were on the gold standard, if we had devalued the gold peg, that would have imposed large losses on those holders. We ultimately went back. Went back to the original peg and adjusted interest rates to protect bondholders from those losses, but they bore them in France. So a comparable situation where a lot of bonds were issued in France to finance the war. In that case, they depreciated relative to the original parity by a factor of 5. So the bondholders bore enormous losses.
That's not seniorage, it's inflating with debt.
Yeah, but it would have similar consequences.
So I'm not sure if you wanted us to respond to some of
Yes.
the other
Go ahead.
comments.
Yeah.
So let me take a whack, and then you guys can jump in and correct me. Emmy asked about does the Fed need a commitment mechanism? Forward guidance was effective. I guess it depends on how you read the forward guidance and what did it mean, and to what extent was it a commitment to do something the Fed didn't want to do later on, and to what extent was it not committing to do something hard later on, but simply communication about the policy reaction function that was helping the public to understand what the committee was likely to do. My read would be it was more the latter than the former, but we could discuss that further. On the additional benefits and costs, I think I agree completely that long-term debt means that the unexpected inflation in our program would have an even bigger effect on debt-to-GDP ratios and would impose losses on foreigners, which you might conceivably feel either better or worse about, but at least it would be different, and would be something you'd want to take into account. And that it would also allow a reduction in distortionary taxes is exactly right. In our model, we're using lump sum taxes in some sense and transfers to make the government's budget constraint fit, but in a more general exercise, you could allow for that, and I agree for sure on that. We talked about the currency abroad. Luis, on your questions, I guess it's right. So I think your first question was basically, should fiscal policy necessarily be constrained by a high level of debt to GDP? Maybe not. Maybe a higher level of debt to GDP is perfectly financeable. But I think, as Emmanuel maybe suggested, even if in the near term it's okay, people may be worried that later on it's not going to be okay. And so there may still be, the fiscal authorities may feel constrained, even if in some sense, in the near term at least, they could spend more without it creating a problem. And then as for how did inflation expectations change as the debt to GDP ratio went up by a lot, it basically didn't. I mean, one of the striking things was inflation expectations remained well anchored around 2. And didn't go up, also didn't go down, despite the fact that inflation was low for quite a long time. But I think that's because the public understood that the Fed had a kind of a framework for policy and was sticking with that and wasn't changing to monetize any of this debt. And so that's just a different exercise than the exercise we had in mind in our paper.
Yeah, so I think it is striking exactly on the last point. There was a lot of work done prior to the financial crisis assessing the impact of a given size rise in the debt to GDP ratio on long-term interest rates, and it was suggested pretty marked effects. And as Bill indicated, obviously it didn't go in line with those estimates. I think for the reason that Bill said, that the big run-ups in debt were not associated in the minds of market participants with a shift in the monetary framework that would push towards monetizing that debt.
Actually, the introduction of interest on reserves, you can think about a commitment device, because you're not going to think about changing your framework. You're not going to monetize your policy action. You're committed to your framework with 2% inflation. So if I can say a couple of things, so one of the problems, so Luis, you raised this idea of why do we need fiscal policy at all? So in these kind of models, if you think about monetary policy in itself, there's many puzzles that these models imply, which is give a lot of power to the commitment of the monetary policy to achieve their objective. That might not be the case. So using G as a form of commitment device, especially when the economy is at the zero lower bound, is one of the idea of this sort of program. Coming back to John's point, I mean, in these models, the price level is always pinned down. I mean, we are assuming all the time that there is no, fiscal dominance. So all the time, the monetary authority is in charge of monetary policy, and you guarantee that the price level is pinned down and inflation is achievable in the long run to 2%. So Amy has this interesting point about how do you think about distortionary taxation in this sort of model? Why? And this kind of coming back to Emmanuel. So it's interesting to think about, what somehow we're thinking about this form of distortionary taxation that is introducing inflation in the economy might be probably better or not. That other form of distortionary taxation is unclear because we don't have other form of distortionary taxation. We have this lump sum in the background that makes, we don't need to think about the, sustainability and the fiscal budget constraints. So, but in principle, as I said before, this idea of fiscal dominance is very important in thinking about how complicated it is to get out of this sort of situation when you want to inflate the economy away, especially when you are at the zero lower bound.
Thank you. Ben, have we learned anything?
I did. David asked me to make a few comments on both papers, so I'm going to yank you back to Neil's paper first for a few minutes and then come back to Bill's paper. Both very interesting papers, and obviously it's the essence of the Hutchins mission to talk about monetary fiscal interactions. On Neil's paper, I thought, I guess my main objection to the paper was there were two really good things in the paper. There's some interesting empirical results about the time series behavior of the cost of financing debt, cross-section time series, and then there's a nice model, but they're not that closely connected. So on the model, I thought, you hear very often that, well, real interest rates are low, therefore we should go out and borrow and, spend. And of course, there's the elementary point that the sustainability of debt depends not on R, but on R minus G plus N. And in a world where growth is low and labor force is in some cases shrinking, as in Japan, maybe low interest rates are not sufficient reason to advocate more fiscal expansion. And Neil does a nice job of analyzing in this model, the point not only that sustainability depends on R minus G plus N, but it also matters what is the source of the change in R. So for example, if R is falling because of population reasons, that's a very different proposition from R falling because of productivity reasons. Now in that model, I had the same reaction everyone else did, which is that it seems that the theoretical result that productivity growth makes debt less sustainable seems kind of implausible. And they cite, Neil cites the Hamilton-Hatzius et al. Paper, which finds empirically that there's not that much relationship between growth rates and real interest rates. But so that would be one question about the model implication. The other implication, some legendary Brookings participant once said, let me put this in the larger context of my own research. So let me do that. There is the issue of the domestic versus the global determination of real interest rates. And one very simple way, I think there's huge complementarity between my global savings story and Larry's secular stagnation story, which of course Neil's done a lot of work on. But I think one way of thinking about the difference is that in the secular stagnation story, it's sort of domestic capital investment opportunities and growth that is the most important determinant of R and savings and investment. Whereas in the global savings glut story, it's more of a global thing. Even if in one country you have low interest rates because you have low growth, then you still can get a high return because you can invest abroad. And that therefore highlights barriers to capital flows. The savings glut story highlights things like reserve accumulation, which are affecting the global market for saving and investment. So anyway, so I agree with Emmanuel's point that some thought about the international flows would be helpful on the model. Now, in terms of the linkage between the model and the very interesting points, empirical findings about the sort of the bouncing back and forth of the net cost of fiscal finance, I guess I just have two general points. One is that what's very interesting, of course, is the time series, and that there's work, I'm sure you're familiar with it, at the Fed, which uses exactly this kind of OLG type modeling, and attributes a big part of the decline, the trend decline in real interest rates, for example, to demographic factors. And so I think a natural direction here would be to try to make this model sort of more, not just comparative statics, but try to address some of the time series. And in particular, if we're trying to think about where we go from here and thinking about, not just historical behavior, but thinking forward, how should the outlook affect our thinking about fiscal sustainability? Obviously, we need to take into account the factors that have brought us to the point we are today. The other aspect of this, and I think the question one really wants to ask is, suppose we take as given or semi-endogenous this behavior of the net cost of finance, which tends to go back from forward to negative to positive. What does that say about optimal financing today? The model doesn't address the question of, okay, we know that the net cost right now is negative, but it could turn positive. What's the optimization problem here? I mean, how can we address? How should we respond to that? What is the social risk aversion? How do you think about that in the case of government finance? So it's, again, very easy to ask people to do stuff which isn't in their original paper, but I think it's an interesting question, given that you are in this kind of stochastic world where the cost of finance is fluctuating, and for reasons which you only partly understand, what's the optimal fiscal plan? And in particular, here, again, Emmanuel mentioned maturity. In Japan, the government can issue 40-year debt at essentially zero nominal interest rates. So to what extent does the ability to issue at different maturities affect that optimization problem? So again, I think two really interesting sets of ideas, the modeling of the determination of the cost of finance, the time series evidence. I would like to see a little more integration of those two. I want to take a moment, just a moment of digression, just to respond to something Emmanuel said about the tremendous benefits to the United States of being on the global dollar standard. I think that's actually very questionable. Seniorage is not that big. The U.S. doesn't pay lower interest rates than other advanced industrial economies. The U.S. provides insurance. There's this work by Gorenshaw and others, that during financial crises, actually, there's huge wealth transfers from the U.S. to other countries via the fact that we hold equities and other countries hold debt, et cetera. So anyway, I just would raise that. I don't think that's an obvious conclusion, that there is, in fact, a big benefit to being to the dollar standard. Let me turn a little bit now to English et al. And the helicopter money discussion. Let me just start just one comment about the implementation. And you talked about this more in the paper, in the presentation in the paper, which is what does it mean, to have helicopter money. There is this issue about the fact that we now pay interest on reserves, and Nariana Koch-Lakota and Larry Summers and other people have raised this, implementation issue as far as helicopter money is concerned. I wonder, so two alternatives, and it would be really interesting to think more about, and I'll explain why I think it's important, but to think more about sort of institutionally how you would implement this. One possibility is to tax reserves, that is, for example, to have in a blog post I wrote, I argued for maybe an inframarginal, paying only on the margin interest on reserves, for example, and changing the inframarginal part. Another way to do it would be to not allow currency to be counted as reserves. So banks would, if they accept currency or did not, it wouldn't be part of the interest payable reserves. So that's one question. The related point, which I think is actually in practice very important, is that inflation, obviously, with long maturity debt, obviously the devaluation of existing debt is another way to do helicopter money. And I think I don't know, maybe in your notes you may have cited the thing I just gave at Japan, in the Bank of Japan a few weeks ago. Peter Olson and I did a calculation, I don't remember it exactly, but something to the effect that it would only take about 0.5% of extra inflation for 3 years to pay for a 2% of GDP fiscal program. Because of the fact that there's so much long-term debt outstanding. So I think and there are other things people have thought about, like the government issuing zero-interest consols and things like that. That, while obviously the central bank could offset those things, at least there's some symbolic value there, and I'll come back to that point in just a second. Okay, now more generally, I think the recent work and a lot of it coming out of the Fed has really helped us think clearly about monetary policy at the zero lower bound. And what we kind of understand now, and I discussed in this room recently the Kiley and Roberts paper, what we kind of understand is that the optimal response to zero lower bound is having a make-up policy where you commit effectively after the end of the zero lower bound episode to have more inflation for a time. And Kiley and Roberts show that has tremendously, if it's credible, of course, that has incredibly beneficial effects in terms of reducing the impact and the frequency of ZLB episodes. And this goes back, and what the helicopter money thing that you're looking at in the paper basically is a combination of fiscal policy and the optimal monetary policy, which is this price level targeting, very much like what Kiley and Roberts described. And to give Michael Woodford credit, I mean, he's been talking about this for a long time, and he argued a long time ago that helicopter money is basically equivalent. I think this is true only in a rational expectations world, but in a rational expectations world, helicopter money is the same thing as this optimal price level targeting strategy. And so then the question really is, given that we understand this basic point, what's the best way to implement that both credibly and effectively. And I think your analysis. I think there's two key issues here about how you implement helicopter money. The first one, I would call the calibration problem, which is that our intuitive idea about money financed spending runs into the problem, which several people already pointed out. You pointed out that the currency stock is low relative to the size of normal fiscal policy, and therefore is a calibration. I think one way I think about this is going back to the old Marty Weitzman quantities versus prices literature, where he said, well, how do you best implement environmental controls? Do you set a fixed amount, a fixed amount of pollution, or do you put an effluent charge? What's optimal? And it turns out it depends on your uncertainty about the benefits and costs of the rule. I think the same thing is going on here in some sense. So what's happening is that you can either implement a price level targeting regime indirectly by making some commitments about the money supply, but given that in reality it's a complicated calibration linking the money supply to the price level, and since it's the price level you really care about, then I think it makes perfectly good sense in this world of uncertainty, et cetera, to basically say, forget the money supply, let's just go direct to the price level, which is what you're saying, and which is what Michael Woodford would say. He said this, So that, so again, what I'm saying is, I'm basically agreeing that on those criteria that you really should be talking about the price level target, and all this other stuff is just creating more noise and making it hard to calibrate your policy and hard for the public to figure out what you're going to do. So I think that's, in some sense, the message of your paper, and which I think I basically agree with. The only thing I would say about this, though, is that, and you also allude to this, is that the communication and credibility issues are, in fact, very important and very difficult. The Bank of Japan is a great example. I mean, they had a big regime change, the change of government, change of governor, change of inflation target, and they've had a lot of difficulty getting inflation expectations up. And so then the question is, are there ways to be more dramatic or effective or plausible in creating these expectations? And that's I don't know the answer to that question. Let me just tell you what I recommended to the Bank of Japan last week, which is very similar to what you were suggesting. What I suggested to them is that if they get to the point now, so they currently have a pretty expansionary policy in place, and interest rates are zero all along the term structure, not just in the short end. So what I recommended to them was that they have monetary fiscal cooperation in the future if they need it, and the way they do it is that the government will announce some fiscal plan, and the Bank of Japan will commit to a price program that is sufficient to keep the debt-GDP ratio from rising. So it's exactly what you're talking about. It's basically a money-financed thing, although it's working, I should add, it's not working through currency, it's working through inflation effect on existing bonds. And as I mentioned at the beginning, it doesn't take a lot of inflation actually to pay for that, given the existing bonds outstanding. Now, then the question is, this would be an optimal policy if it was credible. Would it be credible? I don't know. But I think one way of thinking about it is this, that suppose let's think about the behavior of the fiscal authorities. If they are very concerned about the debt-GDP ratio, which in Japan is very high, perhaps, at least initially, the combination has two benefits. One, of course, is that so Paul Krugman in this room talked about the possibility that there is kind of a multiple equilibrium in inflation, that you can either expect low inflation, in which case that's self-fulfilling because real interest rates remain high, or you could expect high inflation, in which case real interest rates are low, and that's also self-fulfilling. So suppose you're in that kind of low inflation trap, so nothing that Bank of Japan can do, to show that it's actually serious, and so they can announce something, but they can't do anything. So so one advantage of the fiscal plan, of course, is that as you point out, and he points out, it is a concrete measure and a supportive measure by the government, and it will have short-term effects on economic activity. And if inflation expectations are in fact adaptive, as they always say they are in Japan, I don't know if they are or not, but that's their claim, that'll begin a process maybe of moving inflation expectations. But the other advantage is that even if the public doesn't believe the inflation plan of the central bank, if the parliament believes it, then that might make them more willing to take this action. And so, at least initially, all you need to do is convince the government. If the government believes it, then they will take the action and be more aggressive on the fiscal side than they otherwise would be, and maybe this thing will roll a little bit. But anyway, so I think ultimately the recommendation I made to them was pretty similar to what you're recommending, and I think you're probably right that too much evocative, parables are not. Well, economists love evocative parables. I think real people sort of get scared by them, and I understand exactly why. I understand better now than I did in the past why that's potentially a problem. I also talked a bit about independence in central bank independence in my remarks, which are on the Brookings website, and I wanted to draw a big distinction between the government and the central bank coordinating to achieve something which is in fact the central bank's target. I mean, the goal here would be to hit the inflation target, as opposed to something which is not in the mandate of the central bank, like financing government debt or whatever. So I think it's much easier to preserve independence when it's clear that the cooperation is in support of the official mandate of the central bank, and so that eliminates that problem to some extent.
So I'm trying to imagine some future point in history when we're at the zero lower bound and your successor at the Fed goes to Congress and says, here's the plan. You guys run up the debt enough so that we get more inflation, so we don't have a debt to GDP thing. Can you imagine that? Can you imagine Congress?
Well, first of all, that's not what I said. I mean, what I said was that the central bank tells the government, listen, if you guys, so we're obviously, by assumption, we're in a situation where there's high unemployment, right, and we're at the zero lower bound, and we're at deflation risk, and everybody's really concerned about that. And there's reluctance in the Congress, let's say, to take fiscal action, and the central bank says, look, we'll backstop you. But Japan is different from the U.S. in many ways, but in one particular way, which is that I think that monetary policy is really much closer to its absolute limits than it is here in the United States, because interest rates are zero not just at the short end, but all the way out the whole term structure. So I think that's a rather different situation. I mean, I think here, I'm not recommending that for the United States. I think in the context of the United States that, there's still ways to affect the term structure further out, for example, precisely through even if price level targeting doesn't affect inflation expectations, if it affects bond markets, you could still get results.
Do you want to let them respond?
No, let's let some.
Yeah.
I want you to go ahead, Amy.
With regard to the Japan policy, the question I've had is why announce it in advance that you're going to do this fiscal policy? What if you're the Bank of Japan, you just start buying dollars or buying euro? And eventually, what's the worst thing that can happen? Eventually, maybe the yen will depreciate and you make a killing on on your assets, and you're basically like a hedge fund. So one counter argument I've heard is that politically that's infeasible because the U.S. or the euro or whoever was on the other side would get so upset. But what do you think about that question? There's this issue that central banks are always trying to talk down their currency, but from a fiscal standpoint, you could take the view better
Right.
off not trying to talk it down.
Right. So this is Lars Svensson's, what do you call it? The foolproof method. Yeah, foolproof method. I guess you could argue. I think there are some issues with interest parity, and to the extent how far can you get the currency down, et cetera. But I think the first question would be, particularly in the current environment, how would that look and how would it work? And I think there'd be a very strong reaction from some of Japan's key allies on that issue.
But you think your policy would not have that?
But it would be there is in fact a G7 agreement. The G7 agreement says that monetary and fiscal actions that are directed at the domestic economy but have side effects on the exchange rate are fine. But attempts to target the exchange rate, that's a currency war, and that's not legitimate. So the G7 has very explicitly made that distinction.
Yes. So a couple of remarks. So in thinking about your proposal for Japan, I think that definitely is very interesting to introduce in our model long-term debt, nominal long-term debt, and try to see, as Emmanuel was pointing out, I mean, we're thinking about seniorage. We're thinking about we need a lot of inflation. We might not need that much inflation if we have actually long-term nominal debt. So you're going to eat up a lot of that without creating mass inflation. In thinking about Japan, so basically this is a huge transfer. I'm thinking about population. I'm thinking about the population distribution. So you're pretty much taxing the savers in Japan, which presumably are the older people that are holding all these bonds. So pretty much this is one of the problems in Japan. Going through, external, the current account, you're actually, affecting domestic consumption and savings by just, the holders of these bonds are going to have less wealth. So I see some political economy complication of that nature when you think about the population, how the population would think about that. I mean, I believe that probably that the government announced a plan is going to help to some extent. And also when you start thinking about these sort of joint programs between the two authorities, so the idea that it's hard for, I mean, it's implicit in our model that, is always price stability is in charge of the central bank. There is no some sort of fiscal dominance implicit in the whole argument. You can think about a situation during the transition in which people might start believing that, well, pretty much inflation is part of the fiscal authority, so the independence of the central bank is in jeopardy there. So this kind of political economy aspect, how do you think about that? So what is the nature of the agreement? What is the nature of the communication that minimize at the end the problem, which is a time inconsistency problem, which is a credibility problem? So how do you sustain that to make credible that sort of announcement? So I'm thinking about maybe you want to do, coming back to Emmanuel, so you imagine a fiscal plan that's working through capital, which is future output, as opposed to G, which is not in our model, and you finance that with long-term nominal denominated debt. So that may be a way of on the one hand you say, well, but I'm giving you capital tomorrow, which is I invest in today. So there's some benefit that you can actually see as opposed to just through. Is that kind of on the fiscal side, not just G, but do you have some idea of how you implement that plan on the fiscal authority side? I was thinking, you want to think more on the investment side to supplement that, as opposed to the. I don't know what kind of you're thinking about a transfer program? I'm thinking about the fiscal element to it.
Well, in my specific remarks, I suggested that that they use fiscal policy to ease the transition. So the third arrow of Abenomics is structural reform. And
Right.
I was just in Japan, and I had 6 people help me get on the elevator, and I began to wonder a little bit about that issue. And I was wondering whether
So it's just
whether fiscal program that retrained people and supported people and provided child care so that more women could enter the labor force and things like that, whether that would be a good use of the money. They don't need to build any more highways, really.
Exactly.
But yeah, and some of these transfer things that could actually address some of the other issues. On the political economy, inflation tax is also a tax, right?
Right.
Hausman and Whelan gave a paper here on Abenomics, and they argued that one of the reasons that inflation wasn't more credible in Japan was precisely because half the voters are 55 or older or something like that, and they don't like inflation. I'm a little skeptical about that because, after all, the Bank of Japan is independent. It has not been under that much pressure. It has raised the inflation target to 2%. I don't think it's that credible that the government would come in and prevent the Bank of Japan from reaching its target if on other dimensions it was able to reach the target. So I don't know. I mean, obviously political economy is important and all these things, and I think your paper has a lot of implicit political economy in it about what people would consider plausible and times consistent and so on.
So I think it's just probably helpful to underscore that. Sorry. I think it's helpful to underscore that at least under our interpretation, money financing has certain elements of nominal consumption or income targeting, But the really key difference is that it implies essentially a shift in the price level target path that depends on money demand, which is inherently very uncertain. And so, to the extent that essentially the program commits to, in the case of seniorage, never allowing, or basically telling the legislator, you're never going to have to issue any interest-bearing debt to finance this program. That's one form of commitment. Then the implications for the price level are extremely uncertain, and that's why we recommend something in the spirit of Woodford, nominal income targeting, perhaps with a twist, to allow the price level to go up, as Bill illustrated, by a few percent over a long period. So that might be consistent with 2.5 or 3% inflation, but not making any commitment to how the debt would necessarily evolve, because the multipliers might turn out to be smaller than what you think. That's really a key difference, because that seems like it preserves monetary independence, and you could tell the legislature, we think that the multipliers can be bigger than usual, and we think the debt probably isn't going to increase with respect to this, but we're not going to, we can't commit to that, and that's one aspect that we try to emphasize in the paper.
Yeah, it could be an ex-ante commitment, saying,
right,
you know,
exactly.
our
This is what we
models
expect.
predict that a certain price level will make this a neutral debt GDP effect.
Yeah.
We don't necessarily come back ex post and.
That's right, exactly.
Yeah.
That's the key difference. Yeah.
One thing that is important in the current context is that we have a mandate which is a 2% inflation, so people need to realize that there will be a transitory, movements and inflation above the target, but the target should be, 2% and be incredible, which is the assumption in the paper. If I may, coming back to your point about the somehow deflating away the long-term debt outstanding. So the idea of anticipated and non-anticipated inflation is also pretty important here. So how do you create the anticipation and whether you introduce a surprise, or you really people need to believe that your policy is going to be credible enough. So and how that's going to change the portfolio allocation of certain investor that can get out of long-term debt. It's also pretty important, and I'm not sure how to take that into account in the analysis that we're thinking right now. So coming back to the first paper, I mean, you see that there's a willingness by investor to hold long-term debt, U.S. debt. So that tells you something about implicit sustainability of the fiscal program that people are expecting during the horizon in which they're holding the debt. So I mean, these kind of elements are pretty important to take into account. And we're missing all these elements in this sort of simple model that we're considering here. That's why I think the idea of Woodford of thinking of nominal GDP targeting, or even some form of flexible price level targeting is really appealing. The problem is that how do you explain the transition to the policy that is currently in place, or how do you make consistent the policy that is in place with this sort of new regime, assuming that this is a new regime, just to avoid these bygones are bygones in the context of being at a zero lower bound, is what I think is very complicated for only the central bank to implement in this sort of policy. That's why somehow the idea of having some other instrument or fiscal policy or something like that to move expectation is that crucial. So that's kind of what is always in my mind when I think about this. Is the idea of why we have this slide that Bill put out is do we need fiscal policy at all? I think we do. I mean, just the mere announcement. I think we do. I think we have to do something. Otherwise, it requires an incredible amount of credibility to put that in place and to move inflation expectation. I mean, how do you move expectation is actually at the end of the day the whole idea, right?
Neil, Ben crystallized something I've been thinking about, which is, okay, we are where we are. If I read your paper in the current context, and I ask you, what should our optimal debt to GDP ratio be? And you give me the standard economist answer, which it depends. But so what's your gut here? When you think about why rates are low, you think about productivity. If you had to give advice to the government, which way would you lean?
So one thing that I didn't get to show that I think sort of influences my thinking on this a bit is if you look at the correlation between growth rates and the cost of servicing the debt, they appear to be negatively correlated. So that is, periods of low growth are also periods in which there's a relatively high cost of servicing the debt. So, you know, and from my own research, I think that obviously we're in a period where low interest rates are likely to be the case going forward. It seems to me that we want to be building up fiscal space for the next recession. That we'll need additional fiscal policy will be an important part of the response in the next recession, because we're likely to remain near the zero lower bound, and there doesn't seem to be any tolerance for raising the inflation target, and even if we wanted to, it's not entirely clear how we get there, given that we're just having so much trouble getting back to 2%. So my gut would say that that we should be using this time to lower the debt to GDP ratio, so that we have space coming for the next recession.
So I think that Ben has a great point. And so when I think about the net cost, the net fiscal cost, I mean, you treat the risk-free rate and the growth rate of the economy and population as independent variables. They're not independent variables. I mean, it's very important to think about why the risk-free rate is so low. It's going to continue to be low. And it's not the same if that's because you expect productivity to be low in the future, or is this coming from the baby boomers getting out of the labor force and these, all aging, moving the risk-free rate? Or if you think about the risk-free rate going down, or the price of debt coming down, as Emmanuel has in a paper, not because the risk-free rate or the neutral rate is low, but because you have actually a relatively high risk premium in the economy. Those are very important different elements to think about, how to think about debt sustainability down the road. That's very important. I mean, if you think about even a distribution of the debt between domestic and foreigners is also an important element to think about that. So there are many variables imply, and Ben was alluding at. So you need economists. We need some sort of criteria. I mean, what are you trying to optimize here? Is the welfare of who? I mean, the young, the older people. I mean, that's what the whole problem is to some extent. Is that's why economists we're somehow so incompetent, because we don't have a good way of answering this sort of question unless you have a model, and the model is always not a very good way of describing reality, which is pretty complicated. So I think coming back to that. So my main point, or my main concern about the first paper is that if really the risk-free rate is what the whole issue is, I think this is not independent of what's happening with the population growth, and this is really the whole point. I mean, of the paper that I have with, and then probably Neil has with Gotti. I mean, is this population, and if that population, then you might want to take advantage of being a really low risk-neutral, risk-free rate. But this is coming from some really high risk premium that might not be.
Could you solve your model with like a two-state Markov process or something, where productivity jumps between two levels and you're optimizing it so the cost of financing changes and you try to optimize in that?
Yeah, so this is something definitely based on the comments that I wanted to do, and in retrospect, when I was looking at sort of some of the empirical evidence, it seemed to me that it would be great to work with a sort of stochastic version of the life cycle model. It was a little bit more complicated, so given the time, I just stuck with thinking about stationary equilibria and just sort of thinking through these scenarios. But I think it would be feasible to try to take a model like this and see if you can sort of match the basic moments that I've documented in the data, and then ask sort of what are the outcomes under different debt to GDP ratios. It's not obvious to me that so I sort of frame this incentive to increase the level of debt to take advantage of low interest rates and use that as a way of raising revenue. It's not obvious to me that a government should want to do that, right? Mm-hmm. You're introducing a different type of distortion relative to like a distortionary taxation. from a political economy perspective, it seems like debt is the path of least resistance, and especially in the current political environment. So there might be sort of political reasons why policymakers favor debt, but it's not clear economically that it has some great advantage over distortionary taxation or other forms of financing, inflation, for example.
Just to come back to one point about fiscal space, I think, and it echoes earlier questions that Louise raised, and that's, that when Keynes was recommending fiscal expansion in the late 1920s, it's helpful to remember that the debt to GDP ratio was in the range of 200%, and he thought that the UK still had latitude to pursue expansionary fiscal policy given the extreme circumstances they were facing. But I think it's also important to underscore that, at that point, England's commitment to the gold standard was regarded as really irrevocable, that they would do whatever it took to repay that debt without resorting to inflation. And they had gone back to the original parity after World War I. They really didn't deviate after the Napoleonic Wars, so they went back to the original parity in the 1820s. And yet the response could be far different in an environment where the high debt levels make markets think that they might shift their framework.
Okay. Please join me in thanking both the participants and the discussants and Ben for his generous time. And just to explain, Emmy's doing double duty today. She's on the CBO Board of Advisors, so she managed to squeeze us in between. She didn't leave because she was insulted by anything I said. But please join me in thanking everybody. Thank you.